Okay, let's talk about the formula for picking winning stocks. Because look, I know it can be hard to narrow in on what to look for when trying to pick stocks. There are so many things to think about, so how can we fix that? To begin, we need to understand why certain stocks make us money, what stocks we should stay away from, and ask ourselves the age-old question, how can we increase our chances of making money in the stock market? In this video, we will look at 5 stocks that you may very well want to own based off of some very important metrics and indicators. In fact, these are the first things that I look at when picking stocks. We are going to go step by step so everything is clear and easy to follow. So if you are ready, then so am I. Let's begin. Ladies and gentlemen, my name is Pandrea. Let's get into the first thing that we must look at when trying to pick winning stocks. This is actually the first thing that I look at myself. Any guesses? Here, I'll tell you what, let's play a little game. Pause the video and comment down below what the first thing that you should look at when trying to pick stocks. And pause. Alright, did you do it? It was just me. I know you didn't pause the video. I can see you. Okay, so a lot of people are saying price. Now, what do you mean by price? Is it the price of the stock? Well, not quite. See, the price of the stock would be how much you are paying for one share of the company. This tells you practically nothing about the company's value. What we want to be looking at is the market cap, the market capitalization. See, the market cap is how much the entire company is worth on the open market. In other words, how much all the shares combined together equal. So if I own a company and I break up my company into 100,000 shares and the market decides that each share should be traded for $10, then my market capitalization of my company is $1 million. Similarly, if my friend's company only had 10,000 shares outstanding and their share price was, let's say, $100, then the market cap would be also $1 million. See, now we have two companies, one with a $10 share price and another with a $100 share price, yet they are still worth the same amount. So this goes to show you that the price of the actual share doesn't mean anything. I like to think about the market cap as if I were to buy the entire company. How much would you pay? This is essentially what you're asking yourself when you're making an investment into a stock. So now it is up to you to pick a range of market cap that would fit your risk tolerance. A very low market cap can be very risky, right? I mean, take a look at penny stocks. Who makes money off of those?
Penny stocks?
Nobody. You probably lose all your money.
Our ads actually say they can get rich quick.
On the other side, you have the big boys, right? Alphabet, Apple, Amazon, Microsoft. These companies have market caps of over 1 trillion with a T, which is crazy to think about or try to understand how large of a number that actually is. It hurts my brain, and not that that's hard to do, but...
Or Aerotine.
Aerotine, yeah.
Aerotine.
The larger you get as a company, the slower you grow typically, right? So maybe these big companies are not risky enough for you, right? For me, I like to try to have stocks in my portfolio that I can catch that trend upwards towards 1 trillion, as apparently this is the new benchmark standard. So ask yourself, what companies will inevitably join the $1 trillion family? Now, of course, there are a lot of factors at play in valuating a company, and I plan to do a whole video series on how to value companies, so you might want to subscribe and hit the notification bell just so you don't miss it. But just keep it simple to start. What companies are headed to $1 trillion? And what's my pick? Well, I am going to go with PayPal. Looking at its market cap of around 120 billion, I feel that it is way undervalued just from the first impression. They have been around forever, and as a payment platform that is integrated in just about everything, not to mention that they're also getting into the crypto scene, we can check this off as an investing opportunity, perhaps, based off of the metric of the market cap. Okay, next I look at the PE ratio, which is the price to earnings ratio. Now, stay with me because this is very simple, trust me. The price to earnings ratio is a ratio for valuing a company. Now, there are many ways to value a company to figure out how expensive or inexpensive it is. But the PE ratio is one of the most popular, I would say, because it's one simple number. Now, this is sometimes referred to as the price multiple or the earnings multiple. So when you hear somebody saying, oh, you are paying a high multiple for a stock, that means it has a high PE ratio. So the PE ratio is measured by taking the company's current share price and dividing it by its earnings per share. So say I own a company and its share price is $100 and my earnings per share is $5. Then I would have a PE ratio of 20. Now, typically to find companies that might be a good investment to buy, as in the price you pay is a good value for your money, you typically want a low PE ratio relative to the industry or sector standard. A low PE ratio might mean that the company is undervalued, and investors tend to gravitate towards these lower PE stocks because this means that you are paying less for every dollar of earnings that they receive. Now, a high PE ratio might not necessarily be bad. It just means that investors are expecting high growth rates and high earnings in the future, so they're actually willing to pay more right now for it, hoping the company's profits catch up to today's figures. Now, here's something very interesting that I didn't know for the longest time. When you search a company and there is no PE ratio shown, that means that the company doesn't have any earnings yet, or they haven't reported them. You can't divide the stock price by 0 to come up with a PE ratio, right? So hence there would be no PE ratio, which tells you off the bat that this company is not making any money yet. And again, based off of this and other things, you go down the rabbit hole, you do your research. Why aren't they making money? Did they just not report yet? What's going on? Okay, so for my pick for a winning stock based off of the PE ratio, I am going to go with none other than Meta. Meta has a PE ratio of 14, which is less than half of the sector standard. Usually tech companies have a higher PE because of their growth potential. However, Meta's price got, let's just say, a little bit beaten down recently. And while some might say at this level with a relatively low PE, you are getting a good value for your money. Time will tell, but for me, I am adding this to my list of potential winning stocks based off of this metric, the PE ratio. Now, since we spoke about the PE ratio, we now have to understand earnings per share, or EPS. Earnings per share is calculated as the company's profit divided by the shares outstanding. The EPS serves as an indicator of the company's profitability, and what is something that we should all be looking for when wanting to buy a good company? That's right, somebody said it out there, profit. Profit is the heart and soul of a company. Without profit, you cannot grow. And if you cannot grow, then your stock price will in turn not grow. And then if the stock price doesn't grow, people will sell. And that drives down the price. And there's this whole domino effect that continues, and it's all from profit. So I think it's safe to say that the EPS number is an important factor for picking winning stocks. Okay, so let's say my company makes $1 million of profit per year. Pretty good. And it has 100,000 shares outstanding. Assuming I don't pay out any dividends or anything like that, I would take the profit and then divide it by the shares outstanding. And I would get an EPS number of 10. So this means that every share of stock my company has, it makes $10 of earnings. Now, the higher the EPS, the more profitable it is likely to be. And of course, you should be comparing EPS numbers across the particular sector so that you have a good understanding of what a high or low EPS number is. So using the EPS metric, what stock will I pick? I'm gonna go with FedEx. Now, initially I was going to go with Alphabet, which has a very good earnings per share. But for me, it's already such a huge company, and using that first metric of market cap, I see more potential growth in something like FedEx with a market cap of around 60 billion. Its EPS is around 17, which means that it makes $17 of earnings for every share outstanding. And from my experience in my company, in my real company, and not the one we're making up for this video, in my real company, I spend hundreds of thousands of dollars per year on shipping, and shipping costs go up every year. I love it. So it is no surprise that a business like this can be very lucrative. So yeah, based off of the third metric, EPS, I'm adding FedEx to the list. Now, learning all of these skills will only make you more successful. And you can apply that thinking to anything that you want to do. So I think we can conclude that the more skills you learn, the more successful you will be. This is where today's video sponsor comes in, Skillshare. Skillshare is a platform where experts share their expertise, wisdom, and experiences, and learning from experts is the fastest way to become an expert yourself. There is a wide variety of creators on Skillshare that can teach you a wide variety of skills. So you can build your knowledge in your area of interest and then use what you learn to grow personally and professionally. For example, learning more about finance will serve you for the rest of your life. In fact, it can be the best investment that you ever make. So if finance interests us, we can take a look at Skillshare and see all the courses that they have to offer. I found the Modern Money Habits and Personal Finance Masterclass courses to be incredibly useful. And once you go through them, they'll end up giving you the confidence to take your investing future in your own hands. I'm going to leave a link down below that will give the first 1,000 people to sign up a free month of premium Skillshare courses. Thank you to Skillshare for sponsoring this video, and now let's get back into it. All right, let's talk about one of the most important metrics of picking winning stocks, especially over the long run, because, investing is a long-term game, right? Right? Anybody? Look, making money in this market should be focused on compounding interest over time rather than just trying to trade in and out of companies. Hey, at least that's my opinion. Call me crazy. Now, you all know this metric already, and you might already be using it in your portfolio, but let's try to really understand it. This metric is dividends. Dividends paid by a company means that the company is distributing some of their profits to their shareholders. That's us. This is sort of a reward for us buying and holding their stock. Now, when I was 14 years old, I first read a book that spoke about compound interest and showed a nice little chart of the compounding growth of the market with dividends reinvested over a period of 20 years. And I thought to myself, 20 years? Yeah, like when I'm old? It's been 20 years. And if I would have started then investing in dividend-paying companies, I would have way more money than I do now because the magic of compound interest takes hold and rises exponentially the more time you let it do its thing. The math doesn't lie, so instead of trying to pick the next big home run stock, a more safe and consistent and proven approach might be just to invest in companies that consistently pay you a piece of their profits, cha-ching, cha-ching, thank you very much, and then reinvesting that back in to grow your portfolio larger and larger over time. Now, here's the thing with dividends. There is always going to be a balance that you're going to have to determine if it's right for you between the dividend paid out and the appreciation of the stock price. Now, let me tell you what I mean. A lot of the times when you have a high dividend stock, the stock price itself doesn't grow as much or maybe even goes down. This is why you rarely see high growth stocks pay out dividends, because they decide that they would rather use their profits to grow their company even more rather than giving their money to you. So here's an example. AT&T, famous company that pays a high dividend, 8.7% dividend yield. You might think to yourself, ooh, score. But look at its chart. It has lost more than half of its value over the last 5 years. So we probably don't want that. Rather, we want a good balance so that we can collect a good dividend payment while at the same time taking advantage of the price increase of the stock. Okay, so for this, I chose the company JP Morgan Chase. It pays a 2.9 dividend yield, and if you look at the appreciation of the stock over time, you can see that your stock would have grown tremendously if you would have just bought and held this company and reinvested dividends along the way. Now, for the fifth stock, I am going to raise the question to you and really try to do this because I think it's important to start learning about companies and understanding what potentially winning companies look like and separating them from all the losers. Is there a company out there that would have the best of all worlds? A market cap that is attractive to you, not too high, not too low. A company that has good earnings and trades at a decent multiple. And on top of that, pays a good dividend as well. Do companies like that exist? Well, of course they do, and this is where good old-fashioned research comes in. Here, I will give you a head start. Which of these companies would you invest in? Now, don't be scared to do the work because I promise you it'll pay off. The more you learn, the more successful you will be. Not just in investing, but in anything that you want to achieve. If you want to see what I am investing in, you could go ahead, check out my Patreon. Link is down below in the description. More great content is to come on this channel, so subscribe if you haven't already. And do yourselves a favor. You're going to want to check out this video here. It's one of my favorites, and I know you're going to love it. Thanks so much for watching, and we will see you in the next video.